we're going to provide a background of credit, right? As much as we're going to start about credit risk management, I'm sure we need to all know what is credit, what is the credit market, and everything that revolves around credit. Okay, so feel free to ask me questions in case you want to understand something. I know, especially in the first classes, you might have some questions. Also, depending on your background, I understand some come from different fields. So feel free to ask me questions. Right. Okay, so I'm going to proceed. If the sound is not okay, just feel free to turn on your mic and just let me know. Or if you have a patient, just free to turn on your mic and let me know. Also, if the screen is not clear, just let me know so that our recording will be fine. Okay, credit risk management. What is the meaning of credit? The origin of credit, right? In 05, market risk management. Just a few classes, and we'll be talking about the same thing when we're talking about the banks and what is the meaning of credit. So when I talk about credit, let me just pick my pen here if I can. I want to see with this one if I can pick the pen, or it's not possible, or it seems as if it's not possible using this option. Let me just check another one. Okay. Okay. Yeah. So I'll just check in terms of for the full screen and recording is fine. Let's proceed. Okay. So I will not be able to write today. So for today, bear with me. I will not be writing on the screen, but with the coming days, I'm sure I'll be able to write because I can see that if I do full screen, you will not be able to see the screen. So yeah, let me just resort to this. Just a moment. Okay, so credit. The word credit comes from a Latin word credere, meaning trust, right? So when we start talking about talking of credit, there is need for trust, right? Which means even your friend, if you want to borrow here or him some money, there's need for trust. So when we start talking about that aspect of credit, there is need of trust, right? Especially when you're talking about direct financing or direct credit, when you're saying that it's you and me, we are just friends, we want to borrow from each other, I want to borrow from you. There's need for that trust, right? For you to part your resources to me, right? But when it comes to financial institutions, it's difficult to trust, right? That's when you find that they do some due diligence, trying to check maybe your pay slip, your past credit, your credit history, and the like, so that they can establish trust, so that they can see if you are credit worth. So the word credit comes from the word credere, which means trust. When a seller transfers his wealth to a buyer who is agreed to pay later, there is a clear implication of trust. That payment will be made at the agreed date. Growing up in the township, and there will be the sponsor shops, and there will be the tuck shops, right? And your incomes are not that much good. You find that you want to go and buy maybe something. The owner of the shop, because you've built a relationship, they know you've got a personal relationship. You can go and take your stuff. Maybe that's cooking oil, and they write your name, right? No worries. They know where you stay. Maybe you go to the same church, and it's like a social. It's just the same cycle, right? So there is no need for anyone to to worry because you are just the same circle and there is trust, right? So you will find that when you're talking about credit, there is trust, right? When someone part the resources, transfer their wealth to you and you agree to pay, there's need for trust. Okay, I'm sure we're together, right? Okay, let's continue. We're saying, we're not talking about credit now. We are trying to define credit in a broader sense. We're saying it is a transaction between two parties in which one, the creditor or the lender, supplies money, goods, services, or securities in the return for a promise of future payment by the other, the debtor or the borrower. So you see, when you are talking about credit, it's not only about money, right? It can be goods, it can be services, it can be securities. The word security, we're going to use it in often, and the word security can mean an asset, can be an investment. For example, we're talking about shares or stocks of a company, stocks for Pick and Pay, stocks or shares for Absa Bank or for ShopRite. We call them securities. We are going to realize later, especially in 05, that you can borrow stocks. When we are going to talk about stock margins. So we are going to talk about that a bit later, right? So when we are talking about credit, it is a transaction between two parties, the creditor or the lender, who supplies money or goods, services or securities in the return of promise of future payment by the other, with the borrower or the debtor. So in this module, you are going to find a word obligo. Maybe you have not yet encountered it. So instead of borrower debtor, you find that the common term that will be used is obligo. We want to talk about that later. So for now, if maybe you want to read in advance and the like, if you encounter the term obligo, it just means a borrower. Next classes I'm going to be writing on the slide. I'm sure for 05, you remember I was writing to make things much easier. But today I could not manage to write, but you're going to be writing so that it becomes easier. Also, most of our modules have got calculations, so we need to write to have a writing board in doing the calculations. Okay, so you know what happens in the economy? We need credit. For example, Pick and Pay cannot always buy on cash, at cash basis from Coca-Cola, right? Coca-Cola can give Pick and Pay maybe some drinks, maybe some carbonated drinks, and Pick and Pay will pay maybe after 3 months or after they have made the sales or collected the revenue. That's another form of credit. We're going to talk about that in terms of trade credit, right? So you can have credit in terms of going to your bank, borrowing a certain amount, right? That's credit. It's also credit that you want to buy a car, then you see your dealer say there is financing option and the like. That's credit, right? You want to buy your furniture, maybe you're moving into a new house, you want to have new furniture, a TV set, you can go to them, they negotiate credit. You can go to Trude to get some nice couches and maybe some tables, some coffee table and the like, right? It's also, I see this is stopped sharing. Let me just check why it's happening with these Teams.
It is sharing. We could see the screen. Now it's gone.
Oh, okay. So it's me who just thought they stopped.
Yeah.
Okay. Oh, I think there is a question to say, is this 01? Label, I'm sure, if I'm not mistaken, that's level from 348 of Afro Financial Management, right? Yeah. So this is RSK4804, which is credit risk management. The 01 class, RSK4801, I'm sure we're having the class over the weekend. because tomorrow we're going to have the international financial management. So for the risky 01, it's going to be tomorrow, not tomorrow, it will be weekend, which is Saturday or maybe Sunday if the time is okay. So apologies, maybe you might have attended thinking that is 01. I've just posted in all the groups so that those who wanted to we might have other guys who are in the 01 group but they have not yet joined the 04 groups, and also feel free to send the link to other guys so that they can also access. Yeah, so it's 04. Okay, so we're talking about credit, and now we're saying such transactions normally include the payment of interest to the lender, right? So normally when you're talking about credit, right, there is also the payment of interest to the lender or to the creditor, right? Like you go to your bank, you borrow some money, there's a payment of interest. So credit has grown substantially, right? To the extent that if you want to buy some goods on internet right now, maybe go to Take a Lot, you're going to do your checkout, maybe any other, maybe macro, you see that there are options for purchasing those goods using credit. It's also a form of credit. But you realize that maybe you wanted to buy a laptop. You wanted to buy a laptop maybe for maybe 15,000. You find that when you're buying on credit and you're spreading that payment maybe over 6 months or 12 months, the total payment that you're going to make will be maybe something like 16, 17, because there's an interest there that you're supposed to pay. We're going to talk about that later as we proceed. Okay, let's talk about the list of credit. Historically, credit is good if used wisely. So as you're going to proceed with the module, you are going also to try and understand whether credit is good or credit is bad, right? Because as much as there is a good side of credit, as you're going to see, there is also another side of credit that might make us worry. So as we are studying credit risk management, you also need to understand good and bad credit. Because there's also bad credit. There's also traps in credit, right? So good credit use drives economic growth and economic development. That's good credit. What are the risks? Lenders, borrowers, and economies suffer from poor credit management. So if credit is not managed well, it can lead even to disaster. This is personal credit and business credit. If business do not use credit wisely, it can also lead to problems. Even if individuals do not use credit wisely, it can lead to problems. Because with credit, there is that tendency, that propensity, that proclivity to just think like, oh, I want a new iPhone, I can buy it on credit. Then you just buy an iPhone. So the availability of credit can also be abused, right? So credit used to be managed well. What are the key issues? Weak credit, risk analysis, and oversight. These are the things that can lead to the failure of credit to lead to good results. Solution: strong risk management and financial stability. This we are going to talk about later, just in introduction, but we are going to talk about what is credit risk management and all. Okay, let's proceed. Now let's talk about the cost of credit. Remember, we said that usually the transaction between the borrower and the lender involve interest. You see, such transactions normally include the payment of interest to the lender. But now we want to ask, why is there interest? So the interest, guys, is now the cost of credit, right? Because I'm giving you my money and you are going to return me after a year, and there's an interest there. That interest is the cost of credit. Because you're going to, for example, I gave you $1,000 or 1,000 rand, then at the end of the year you're going to give me 1,100. $100 or 100 rand is the cost of credit, and it is the interest, right? So there is sometimes when we can try to differentiate to say the cost of credit, right, and interest and the like, but for now let's take it as that. Okay, so I said the cost of credit is the additional amount over and above the amount borrowed that the borrower has to pay. So the cost of credit is the additional amount over and above the amount borrowed that the borrower has to pay. It includes interest, arrangement fees, ledger and administration fees, and any other charges. So why I'm saying so? Now when you are offering credit, especially at a business level, a company cannot just come to maybe FNB or ABSA looking for credit, then immediately we process a loan of 1 million or 200 million rand and we give them. No, we need to do a credit risk analysis to see the probability that the company is going to pay back. Such is not for free. We're going to incur cost doing all that process. The cost doing that process, right? In other instances, there are what are called syndicate loans, right? Which are loans given by a group of banks. For example, a company like, let me say Coca-Cola, want to build a huge plant in South Africa, and they are looking for a 1 billion loan facility. It can be difficult for one bank to give that loan. Why? Because if the company defaults, the word default is failure to pay back. We're going to talk about that later. Because if the company fails to pay back, it is that one company, it is that one bank that gave the loan which is going to have that big loss. You understand? But when the companies are giving loans to multinational companies, when banks are giving loans to multinational companies or big companies which require a big sum, they can form what they call a syndicate. Then they do meetings to see maybe ABSA are going to give 30%, FNB 20%, maybe Nedbank another 10%, another Investec, and you see Capitec, right? Standard Bank is going to also to offer another percent, so that in the event that there is default or there is failure to pay back by that company, one bank is not going to incur huge losses. So that process of combining management from FNB, ABSA, Nedbank, Capitec, Standard Bank, Investec is not going to be free. There will be meetings and there will be time consumed. There's going to be lunch and the like. Those are costs, and these costs are involved in a bid to issue or to offer a loan to a certain company. So that has to be also taken into account when we are charging a loan. The administration fees, the processing and the like. I'm sure you understand what I'm talking about. If you have questions, you can ask. Okay. Today we're not writing on the slide, so it's a bit different. I usually like to write, love to write. Okay. So let's ignore about for now. Let's ignore about the administration cost, the cost of meeting that you talked about, and try to think, why are you charging interest? Because when I talk to my friend to say, I'm in a crisis, give me 5,000. They can just give me 5,000, and I'll give them back that 5,000 maybe 2 months down there. They are not charging me interest. But why in some other instances a colleague can charge interest or a bank charges interest? Right? They charge interest based on the aspect of opportunity cost. So I'm sure you understood the cost of credit. I'm sure we read it and you understood. If you have questions, you can ask. So we're saying that the reason why also there is a cost on credit, there is an aspect of opportunity cost. To those who did economics, they understand that when you're talking about opportunity cost, we're talking about the cost of the next best alternative for gold. One of the examples that used to be given when we're doing economics and you read economics textbook is to say, okay, you have your 80 rand, right? And maybe let's assume you are still in high school. Let's assume that maybe you are grade 11 and like there are two options. You can take the 8 rand for a movie, go and watch a movie, or you can take that 80 rand and buy a textbook, an economics textbook, right? If you choose to go and watch a movie, remember you're going to lose the textbook because we have limited resources. So in economics, you'll find that when we are doing financial management, we're talking about the previous class. I'm sure we did not attend, we are not financial management class, but we're talking about the relationship between financial management and economics. You find that all these modules, there is a relationship with economics. The reason why we have someone going to ask you some money from someone, it means the resources are not enough. We have limited resources. So when we're talking about economics, there is an aspect of scarcity that we talk about. There is what we call scarcity. Resources are limited. As such, there should be a choice. We have to make a choice, either for a movie or to buy the textbook that might make you have a good grade and maybe become an economist or an accountant or risk manager one day. Right? But since we said there is scarcity, which is limited resources, and there is a choice. When there is a choice, there is an opportunity cost. We have lost an opportunity. By going to the movie, we could not buy the textbook because we only have 80 rand. Alright, now coming back to the aspect of credit, that was just an example for you to understand what we mean by opportunity cost. But if you choose also to go and buy the textbook, you are going to lose the interesting movie. Alright, so now in credit, if you go to the bank, let's say you go to FNB or ABSA and you're looking for a loan of 100 million, if they give you 100 million and you have to return it over maybe 5 years, they are going to charge you interest. Why? Because there's an opportunity cost. If they were going to remain with that 100 million, maybe they could use that to develop maybe a house project. They are going to sell those houses later. Maybe they could take that money and invest in solar power project and as diversification of the business assets, of the bank assets, and also maybe be part of an independent power producer supplying maybe to the grid. And it's going to give them more income and add value to the shareholders. Because they gave you money, right? They have lost another opportunity. So they have to charge you because they could have obtained maybe an extra 10 million with that 100,000 if they did not give you the money. So you find that the cost of credit is also opportunity cost. We gave you the money, but we could use it for another best alternative for God, or maybe there is another place, another company which needs the same money. Okay, let's proceed. So I'm saying, when the creditor passes the resources to the debtor, there is an incentive for doing so. The incentive is justified in terms of the opportunity cost. Opportunity cost in the sense that the capital could be used for some other profitable venture by the creditor. The opportunity cost of a choice, is the value of the best alternative for God. Hence, lending comes as a sacrifice to the next best alternative. Similar to the scene going to the movie, you are sacrificing the textbook for the movie, or maybe you are sacrificing the movie for the textbook. There is an opportunity cost, and as banks or as creditors, we need to charge for that opportunity cost. We gave you the resources that we could use for something else. So can you get them for free? And maybe you're going to do well with that money. And you're not going to be part of your business anyway. You're going to enjoy the money alone. Maybe your business is going to be nice. It's you and your other guys who are going to Dubai for holiday and the like. So we need to place a cost. Are we together, guys?
Yes, we are. We're following.
Well, that's fine. Let's proceed. Credit is cost of capital. Credit is cost of capital. Read this one. The cost of capital measures the cost that a business incurs to finance its operations. So today I'm not writing. I really want to write. I was going to draw something. It's just my pen can't do that today. Just a moment. Let me see if I can do something. Okay, I'm sure if I do this, then the sharing will stop. The sharing will stop, guys. You can't see the document. Are you able to see the document that I'm flipping?
Are you talking? Just want to let you know that you muted yourself.
Oh.
In case you're talking.
Yes, I'm talking. I actually muted myself mistakenly. Oh, okay.
Okay.
So I wanted to do full screen. So I just wanted to check with you if you will be able to see my document is full screen. Let me just try to do something and see.
I'll let you know as soon as it pops up.
Okay, well, it's fine. Okay, but I just want to check now. If I do this, will you be able to see the screen? Are you seeing the screen or no?
No, now we can't see.
We can't see it.
Yes.
Well, that's fine. I think so. I think I'm not going to be able to be writing. So let's just resort to the view that we've been using before, which is this, so that we can move. Okay. Let me just share again. Okay. I'm sure it's now available, right?
Yes, we can see your slides.
Well, that's fine. Okay. So, I wanted to do some illustration regarding to credit as cost of capital, right? So let's say the cost of capital measures the cost that a business incurs to finance its operations. The cost of capital is the cost of the company's funds, both debt and equity. So, when a company is financing its operations, right? For example, the company is already operating, right? And they want to venture into a new project, right? A big project. They might not have enough funds for that project. No. Maybe Transnet, they want to expand their rail, right? But they do not have enough funds for them to invest in that project because they want to invest in bullet trains and the like. It means that they might need to borrow some money. And I want to use an example of a company that is not owned by the government. I'm thinking in terms of a company that has got owners, private owners, right? So you find that such a company, for example, we can talk of DSTV, they want to invest in maybe satellites and the like. They've got two types of capital in most cases. There is capital that has been contributed by the shareholders, the owners of the company. Maybe it's you are starting your bakery project, or maybe you are starting your farming business. You have saved $1 million or maybe 300, I don't know. That's the capital you have contributed yourself. Maybe with your other guys. It's the equity capital. That is capital that has been contributed by the shareholders, the owners of the business. We're going to talk about that later, right? Because it's not of much interest for us. But as the business is growing, you want to acquire maybe more farmland, you might need to borrow some money. That money that you are borrowing is capital, it's part of the capital, right? So because you are saying the total capital of the firm is equity capital, the money that you have pooled, you maybe with your friends, but now it's not enough. You want to grow the business, you go now to ABSA to borrow, you now go to Standard Bank and borrow. So now you've got two types of capital. You've got equity and you've got debt. This debt now is the one that we have got interest over. That is the one that we are much interested in. Because if I say interested, we have got also interest in our discussion, you to confuse. Okay, that's the one that we are much interested in. Because that's the one say credit is cost of capital. Right? So what we need to know is that when we borrow that money from us, we need to make profits enough for us to be able to pay back that loan and interest. Right? But I'm not going to talk about it much today. The money that we have invested or saved, or you have invested yourself with your friends, that 300 million is equity. You also need a return. The required rate of return. You also need a return. And you're going to talk about it later. But our understanding, or what we need to understand on this slide, is that credit to a business is part of the cost of credit to a business has got also an aspect of the cost of capital, right? And we're gonna do some calculations later, right? Why? Because the credit is part of the capital of the firm. We've got equity and debt. So debt capital is the credit. I'm sure we're together. Any patience? Let's ask. Company cost of capital. So here we're doing a verification or a distinction of these types of capital. On the other side, you've got equity. On the other side, you've got debt. The below calculations, do not worry about them. We will rarely use them in this module, or not at all, because we will not do calculations of much of weighted average cost of capital. But this is just showing you that the total cost of capital for a firm is equity and debt. Equity, that's the money that you've contributed as owners. Debt is now the money that you borrow to supplement sometimes what you already have. If you have, in the case that you have contributed some money on your own. So these calculations, do not worry about them. We're not going to use them. But it's just a way to show that the cost for debt will be calculated is that way, to say R multiplied by R is equal to debt which is the percentage 1 multiplied by the tax rate. But for now, let's leave that. We're going to talk of any if necessary later. Okay. Oh, okay. I'm pressing the wrong. Okay. So now let's talk about interest, because I was talking about to say the reason why I was emphasizing above to say there is opportunity cost, the cinema, the movie, the textbook, is to try to justify the reason why there's need to charge interest. Why? Because there are some jurisdictions or some other countries or some other countries which do not charge, or societies, communities which do not charge interest because they considered interest as evil. Right. Let's talk with the reason why they consider interest as evil. So we're saying some jurisdictions prohibit interest or riba, especially in the Islamic society. So if you're going for an MBA, maybe you do an MBA with another institution, they also have sometimes a module or a part of the module called Islamic banking. So you understand about Islamic banking and what we call the musharaki banking and the like. But let's just talk about that a bit. The prohibition of riba stems from the Sharia tenet that money by itself should not be recognized as a commodity, and consequently there should be no reward for its use. Right? Under Sharia, money is perceived only as a medium of exchange and a unit of measurement, so it should not be taken as a commodity and someone require reward on it. Islamic derivative products must therefore be based on underlying transaction in tangible commodities as opposed to mere superficial cash flows. So this was taken from the practical law of UK. So we're saying there are some jurisdictions which prohibit the charge of interest or riba. Why? Because they take money just as a medium of exchange and a unit of measurement, not a commodity from which you can try to reap or make a gain. Okay, let's proceed. Let's proceed. Okay. But we once also talked about credit to say, is credit really good? Maybe when it's used wisely. Right? So we need to understand credit why. Because if the borrower is not aware, credit can harm them. Even the creditor, if they are not prudent enough, credit can transfer their wealth to the borrower. So we're going to talk about that. Credit should be fair. Interest rates should, however, justifiable to those jurisdictions which charge interest. Interest rate should be, however, justifiable and not harm the borrower. Interest rates that are exorbitant are therefore not for economic development, and they are not justifiable by any legal, by any regulator. Right? They will not be allowed. Exorbitant interest rates defraud the economic significance of credit. It therefore means the borrower should be aware. Right? So we need to understand about this. Right? There is a concept called the greater fool. Right? So what do we mean is that it's usually used in finance to say I can buy an asset at a higher price, knowing that someone else will be interested to buy it even at a higher price. Right? The greater fool theory. So you find that in the credit market, there are some other creditors or other lenders who charge exorbitant interest rates. To say maybe you're a company, or maybe a startup company, a small business, you want to expand your business, you go to look for credit, then you are charged the credit that even if you go and try to make it for a business, you will not be able to make profits enough to pay the borrowed amount and the interest. So it is a trap which the lender will make to collect, maybe to take your assets, because you have pledged your assets maybe as collateral. So exorbitant interest rates are not good for the economy. Like interest rate like 20% and above, they can be considered too high. It might not be possible for you to run the business, make profit, and be able to service the debt. So there is need for a regulator to check the interest charged. Right? But in every economy, you find that there will be those guys like the loan sharks and they like those guys who charge exorbitant interest, and people will just go and go tripped, and they are going to charge those high interest. In every economy, there is that corner of the society where there will be interest, there will be credit offered at even higher prices, higher interest rates, which is not productive for the economy. So exorbitant interests are not good for the economy. We'll proceed about that. Okay, crediting is the oil of the economic engine, right? Without crediting, business will fail, right? You know, I was giving an example that I once made with a tracking company, right? You can do some business. You got a contract and you are moving to and from, and maybe for 2 months and the payment has not yet been done, but the drivers need payment, the management need payment, the trucks need also fuel, right? But maybe you want to create good relationships. You don't want to quickly ask for the payment. Maybe the agreement is payment after 2 months or what? You see, you're doing business, but you need fuel for the trucks. They need for servicing the drivers, food. Need food allowances. They go, maybe you're doing contract from South Africa, DRC, Zimbabwe, Zambia, Botswana. You need to have the money, right? It is now credit that helps you to bridge that gap. Working capital. We're going to talk about working capital in this module. So to have that working capital for the business to go, to pay salaries, to get the money for fuel, you need credit, right? Even businesses like Pick and Pay, that was going to be difficult. Checkers and the like, to say every time they will need to buy coke, they need to pay cash, they need to get stock, they need to pay cash. That's the reason why we've also trade credit. We give you the products. After maybe a month we've made the sales, you give us our payment, right? So credit is very important if it's used wisely, because there are a lot of ways which credit becomes even worse. Like, because I'm sure if you go even outside today to tomorrow going to work, there is a billboard for credit, right? On your phone, there are messages coming. You can borrow what. You go on the internet, you see. So as much as it's good, it can end up being disastrous if you do not consider twice whether business or personal credit. Because everywhere there's credit, we offer credit, and at the end of the day, if you do not consider it wisely, you can get into that trap even at personal level, borrowing and the like. At the end of the day, you now have a lot of maybe your account has got 10 debit orders, and your salary will come like squished, like squeezed, like it's, and going to work is no longer interesting anymore. Anger issues, was mental health challenges and the like, because of inappropriate use of credit. Modern credit is the oil of commerce, since vast ongoing volumes of goods and services providing employment for millions are only possible on a buy now and pay later basis. Prior to extending credit, before extending credit, we must evaluate the customer, determine the amount and the term of credit, and take precautions to timely collect. So if I think in terms of us as the creditor or the lender, before we lend credit, we give credit, we need to see the amount of credit that we should give to the borrower, and when to collect it, and even the interest to charge. So when I talk about interest, you are going to be given, like the previous year, you're going to be given an assignment to say, provide, go and maybe consult a bank or any company that offers credit, and give an account of how do they conduct the credit process, right? Maybe we're going to Truth. Because Truth also offer credit. Woolworth, they offer credit. Truth, they offer credit. All those companies. Why? Because when you're going to buy goods, your clothes on credit, and you create an account and the like, that's credit. They also need to know the maximum amount you can spend on your account in terms of credit, right? That can be based on your salary. So someone who is earning 20,000, they've got maybe a maximum number of, they've got an amount they can spend. And they also need maybe a pay slip and the like, because maybe you might have also some credit and some deductions already on your account. Right? Maybe they might not be available, but they'll try to get all that information. Because at the end of the day, we can't have someone earning 20,000 and they've got debit orders and deductions of 15,000. Because we are trying to check, okay, what's your age? You've got kids, right? So if we are going to also give you an account that you can collect, maybe you can have clothes for 5,000, then you remain with nothing. Maybe you need to pay rentals and the like. So that also needs to be taken into account. Okay, but credit is good. Credit, the cost to the lender. Let's look also at the lender side, the cost to the lender. I'm sure my time is also, the time is running also a bit fast, but I'm sure we can just, I scheduled the meeting to say 7:30 to 8:30, but maybe we can just extend maybe some few minutes. Okay, so we also say that credit, cost to the lender. Credit is an essential marketing tool. It bears a cost. The cost of the seller having to borrow until the customer's payment arrives. Credit is an essential marketing tool. It bears a cost. The cost of the seller having to borrow until the customer's payment arrives. So you see, also the providers of credit, in particular companies, for example, Truwood, let's say Woolworth, they're selling clothes, they're selling furniture, they're selling cars, right? But to improve their sales, they can offer better credit terms or liberal credit terms, which are nice for customers to pay and buy. Both know we're buying on credit. But there is a cost for doing such, which I say that the borrowers might take time to pay, but you need to have money to run the business. You need to pay water bills, electricity bills, employees, stationery. You might be forced now to go and borrow even someone for you to cover the gap of some bills and day-to-day operations, the working capital required. You need to pay for that. You might end up going to find somewhere to get some money at a cost because the borrowers have not yet paid their accounts, right? So there is also the cost to the lender. I'm sure you're understanding that credit, we're saying that it's going to be offered by banks, it's going to be offered by companies like selling goods. We're giving you calls on credit, we're giving you finish on credit. But the time between us giving you the credit, right, and when you're going to pay big, there might be some crisis. We might need some finances for day-to-day operation, bills, water bills, salaries. They are required. And we might end up being forced to go and borrow to pay for that. Ideally, that cost is the price. Ideally, that cost is in the price. But as most customers pay later than agreed, the extra unplanned costs erode the planned profit. So you see, when we are in financial management, we even went on to the extent of calculating the cost to say, we might have credit terms which say our customers will give them a loan, or maybe we can say they can borrow, they can take clothes and they pay within 30 days, right? And we are going to check them a small interest. That interest will also cater for some delayed payment, right? But customers usually even might take longer than expected to pay, and that becomes a problem. So you might find that improving or making your credit standards more liberal or favorable to customers to say, instead of paying within 30 days, pay over 60 days. We can find that it might not be even beneficial, even though we're going to have more sales, Because they might take even longer to pay back. Some pay 90 days and the like. Some even choose not to pay. So you find that when you are offering goods on credit or offering a credit, you need to be so cautious, because it might be end up a cost for you, to you, because of delayed payment. The right to receive trade credit is very often taken for granted, which goes a long way in explaining the need for tactic and diplomacy. So you see, when I talk about trade credit, we are saying that you are giving us, the supplier is giving us the goods made by a supermarket. They are giving us their goods, maybe 100,000 products, and you are not going to give them cash. It seems as if we took those products on credit and we pay them after selling, or maybe an agreed period. Right? And that can be also taken as a right and not a privilege. Right? To the extent that the supermarket and the retailers can abuse that. So it means that the supply of goods also need to be prudent when providing trade credit. It's not something that every retailer should be granted. It should be granted maybe based on certain relationships and certain guidelines. Because if you've worked in the payment department, especially in the companies, in the payment department, especially for small firms, you'll find that payments are sometimes made in a way that is not even professional. The one who is to complain is the one that you pay. I still remember when I go to one of the jobs that I was doing the payments, right? I did not know. It was a small company. I didn't know that much. So I was giving all this money, and I was so trusted, and so yeah. So the guys were coming, like it was a company that was also in the transport sector. My invoice is this. I did this and this. I took the money and give them. They're like, someone come and take the money and give them, right? It was a small company. I'm sure you understand. Because the owner of the company, they trusted me, and he was also coming to work. So I was doing everything. Then he came and say, I'm not saying that everyone who comes, you have to give the money. We end up having even nothing for fuel and the like, right? So now the trick that was now used is to say, when someone comes to collect their payment, I will say, talk to the boss, right? Then when someone calls them, they are going to beat around the bushes. Then later on, maybe someone left the office, they will say, talk to the guy in the office. Me, I'm also going to say, talk to him. So I end up being stressed, because these people, in me, I was the one that was going to interact with the guys directly, and they'll be angry, right? And it will be like, talk to this one. He said, talk to the guy in the office. The guy will always talk to, So you'll find that in small companies or other companies, there might be that challenge to say the prioritization of payments can differ. You have given your goods to someone on credit, and they might not prioritize you. So there is need for professionalism, diplomacy, when you are dealing with trade credit. Okay, let's proceed. Justification of interest. We said some other jurisdictions, they do not charge interest, but let's now conclude the reason why interest is necessary. Cost of capital charged by lenders who do not have the right to enjoy the fruits of ownership. Remember, we said you have got a farm, you have invested 300 million in a big farm, you've got a lot of projects running there, but you need more money. You go and borrow money from the bank to invest in your farm, right? Let's assume that everything went on successful, and your business has grown, your farm, you are now doing also processing, meat processing, co-processing and the like. Are the guys who gave you the money, the bank, going to be part of you? Of your dividends, of your profits? No. Since they are not going to enjoy the fruits of the business, what they are supposed to enjoy is the interest. So they have to charge interest. Because if things go well, you are not going to enjoy with them. But if things go bad, you might also want them to suffer. Because when you fail, when the business fails, they might lose their money. What if things go well? They have to also to quickly get their money. So in 02, we are going also to have a question, maybe they can be given as an assignment or even as serious past assignments, where they are saying, talking about the conflict of interest between the owners of the company, right, which is the shareholders, and the creditors, the creditors, those who gave you the money. Shareholders, you as the owners of the company are saying, try to make projects that are going to give us a lot of money as the owners of the company. With whose money? With the borrowed money from the bank. But the bank, with the credit, are saying, please make sure that the projects that we are getting into have got reasonable risk. Because if you get into too much risk, we're going to lose our money. Alright? So there will be a conflict. Now who are in the problem is the management. Because we've got the principal agent problem. We've got the management which are the agent working for the principal. But this management, you have to also consider all the stakeholders. They should not just work in a way to make more profits for the shareholders and ignoring the providers of funds, the creditors. Because if things go bad, the creditors are going to lose their money. If things go well and they make huge profits, the creditors are only just going to get their interest and nothing more. I'm sure you understand what I'm saying. You get much as we proceed. Lenders such as banks or bondholders earn interest, but do not share in profits. Do not share profits, dividends, or decision making like equity owners or shareholders. So give them their interest at least. Since they lack ownership benefits of the company or the entity in question, they charge interest or required returns to compensate for the risk of lending money. So at least they're charging interest for the risk of lending money. Remember, there's always a risk even with professional business management. Right. Okay, let's proceed. I'll just proceed a little so that I do not take much of your time, guys. Okay, so when we say we give credit, it's not an obvious case that money is going to be paid back, everything, right? There is a probability that the borrower might fail to pay back, willingly or unwilling, right? And usually when borrowing from banks, usually the failure to pay back is not willingness, it's because of some other factors. But we're going to talk about some other interesting things later. I'm sure you've realized that there are people, maybe you have borrowed your money, maybe they're friends, your 500 rand 10 years ago, they did not give you back. It doesn't mean, but you know they have it. But when they just feel they don't want to give you. And you're going to realize that is your procedure. Credit risk management or analysis should be done very well. There's a statement that if you ask a professional banker or a well-experienced banker, they will tell you that usually the rich customers, the borrowers, are the ones who do not pay back. Do you know that? I've realized that if you give someone some money to someone who's not very rich, sometimes, if they do not have the money, they can just come to you and say, I still know. They just have maybe that kid to say, I'm away, I'm going to pay back. But I like the example that I give, I like also to give examples. Like working for the same company, I was still new. Then there are some small deals that you do, then someone maybe we are doing a deal, then there's some change that is remaining. That 200 rand what you will be big for you, right? Then you are dealing with someone with a certain company, then they've got you 200 rand change, maybe let's say 1,000 rand, then they say they're going to give you, and maybe because sometimes when you're running those business, it's difficult sometimes to make it completely professional and account for everything, because there is a breakdown. You need maybe to buy food, you cannot write down everything quickly. So if you're doing all those things, if you do not become cautious, you end up having those costs. So when you are saying to someone, you've got 200 rand that you owe us, then someone say, so you're calling me for 200 rand? Do you think I can run away with the 200 rand? And because they're saying, the car that I'm driving, do you think I can run away with the 200 rand? It happens with those ones with driving a big car and the like. Until 6 months, you just choose to ignore it and you take your money to cover that for that, right? But if you're dealing with someone, maybe they understand that maybe 200 rand is life changing to you. So you'll find that when you're doing credit risk analysis, you need to be so cautious, because even the seeming rich customers, you find that they're the ones who fail to pay back in most times. But let's talk about other factors, right? We have other factors, especially at business credit level, which affect the ability of the borrower to service their debt or to pay back. So I say interest rate risky is the risk of not being able to cover the fixed interest charge. You might fail to pay back the interest, and also you might even fail to pay back the principal. So some of the things are business cycles. When I talk about business cycles, this is normal economic activity. These are general economic activity. For example, we might be operating in a boom, like things are going well in environment, like the 2010, there was World Cup, the South Africa was good. Generally, if someone borrows you, if a company borrows, they can easily pay back because the economy is performing well, right? But during COVID, things were bad and the like. Maybe the company that borrowed you funds is a company in the tourism industry and are not operating because the economy is low, economic activity is low. They might fail to pay you back because of business cycle. The general economic activity, it can affect disposable income in the hands of the general public. Competition can affect your revenue and sales and make the business fail to pay back because of the competition, which is squeezing the sales. Excessive leverage, if you've got a lot of debt, it can affect your ability to pay back the interest because you've got a huge amount of debt. So the amount that you need to take from your profits to pay as interest is huge. Government regulations, new technology can also render your products obsolete, right? Just thinking the coming in of memory sticks, and you have a plant that you have been operating to manufacture DVD players or VCRs, and there's a new technology can affect you. Mismanagement, so also poor financial planning and having crooks within the management of the company, or people who are not keen or financially literate, right? They can also have good finance degrees but not well experienced. That can also lead to failure to pay back, which you are saying non-performing loans. So guys, we'll talk much